How are you, Mr. Jerry?
Mr. Jerry is fine. I do not know how about that side.
All good, thanks.
That's fine. You're welcome. Nice to be with you in this first lecture, Miss Lucretia.
Yes, sir.
That's great. Maybe you're hiding your face. I didn't know. Um, but I thought the purpose of the video should be for
Mm.
us to interact. Being our first lecture, so that maybe we set the rules straight from the word go. I'm
Yeah,
glad
for sure.
you passed your FA1. Is that true?
FA1, yes,
You did pass.
I did.
That's wonderful. That's good news to us. So you must pass this FA2 by when?
Uh,
When are you intending to pass it?
June.
All right. So we must move, right?
Mm.
That's great. So I'm going to share the first week's lecture. My battery is almost about 60%, so we need to do some marathon, isn't it?
Yeah.
Yeah. So let me share the screen as we chat along.
Mm. It's
Are you
more of
seeing it?
revision, sir, because I was doing my lessons actually last year, but I'm now kunyora.
Or you didn't write? So you intend
But
to.
atinazo pedza I do my syllabus, and I took a long break. Saka zvacho zvinenge zvatobuda musoro. I think takagumisira muna July, end of July.
My God, you are now doing somebody else, right?
Yeah, I was, but no, actually,
ukatiza sei ukati aiwa sei havashandiki navo vanodhura something like that, huh?
I'm
Ah,
Jura, sure.
eh? Ndachura here.
Ah, it wasn't too bad, but I think at that point I wasn't managing. So,
All right, that's fine. That's fine, Lucretia. So we're going to talk about the accounting equation and financial statements. Just a recap, as
yeah.
I've indicated on the screen, is just some recap.
Uh,
Um, So being a recap, we mustn't waste much of our time on it, isn't it?
yeah.
Okay, that's great. Uh, the objectives of the lecture, by the end of the lecture, you should be able to appreciate the distinction between assets and liabilities. I know you
Mm.
now know what these things are, but I hope if you can just give me a simple, definition of an asset and a liability, then we move forward, isn't it? Can you tell me
Yeah.
what is an asset and what is a liability?
An asset is something which can be used for a business for a long term. Liability is something that it's like a creditor, which the company is owing money to maybe a supplier or etc.
Uh, that's that's correct. But an asset need not to be there for a long time. Remember, assets are grouped in two forms. That is,
Mm.
there
Yes.
is, I mean, there
Current
are
liability,
current assets
current
and
asset.
long-term liability. Long-term assets or non-current assets, right?
Yes.
We have current and non-current. All right. Similarly to the liabilities, we have got current liabilities and long-term liabilities. Good. So I'm sure you are happy with the distinction. So this one is done. Okay. Now, you must or you should be able to um, get some grounding in main accounting concepts. Actually, you need to be able to tell me the main accounting concepts or theories, um, for as part of your, your future understanding of the accounting discipline. So you should be able to tell me those theories. An example of a theory, like example, the going concern, a theory or
Yeah.
assumption, right? I want you to tell me at the end of the lecture. So as I will be presenting, please make sure that everything is being cast at the back of your head or in your heart. I do not know where you are going to store them, is it? Anyway, the video is going to
Okay.
be shared. Yeah, the video is going to be shared with you by the end of the lecture. But not today, obviously, because
Okay.
as you can see in my office, it's dark. There's no Zesa, so I'm relying on my laptop battery. All
All
right.
right.
Um, then the other objective is the lecture is intended to enable students to appreciate the need for accounting standards and have an appreciation of a select of accounting standards. So we are going to touch on a few standards, but at the same time, you need to understand why do we have accounting standards by the end of the day instead of accounting laws and regulations. You should pinpoint why. Yeah. Then, lastly, the lecture is also intended to give a recap of the accounting equation and financial statements. Why are we saying recap? Because you have done these things in your FA1. Is that correct?
Correct.
Right. So let's move on. What's going on? My screen is not responsive. Hey, oh my God, it's not moving. Okay, assets and liabilities. A business owns assets and owes liabilities. That's the idea. Um, it's very rare to find a business that is running without assets. All right, even if it is an online business, it has assets in the form of a bank account, also in the form of some intangible asset. That website to some extent is actually an asset for the company. um then liabilities, obviously, they might be having some financiers, bank loans, and so forth that enable them to, enable them to run their business. So your definition was actually correct, where you said that assets are those items which belong to a business and are used in the running of that business. All right. An example, we say that there could be some current assets, which are inventories, receivables, cash, bank. Those are current assets. And then non-current assets include machinery, office equipment, fixtures, furnitures, etc. Those are the non-current assets. Then liabilities, we have got current liabilities, for example, current payables, those ones which are going to be paid within 1 year, and long term, which are going to be paid over a year. Okay, they are going to be long term. We know that stuff, isn't it? Good. Now, the conceptual framework. There's what is called conceptual framework. This one is not an accounting standard, but it's like some foundational principle or some peg that gives accountants some some foundational knowledge or theory. They develop the accounting standards being informed by what is called the conceptual framework. Okay, so there are certain principles that underpin accounting as a discipline. Those principles have to be respected, and they are found in the conceptual framework. Tomorrow, I want you to download the conceptual framework, and I want you to show me on my WhatsApp that, hey, say this is conceptual framework. I've downloaded it, okay, because there are certain questions and there are certain tasks I'm going to give you that require you to present something on these live lectures. You are not going to just come here and listen to me. So sometimes I'll give you an assignment and say, present on this particular issue. So I want you to come
Okay.
confident, yeah, come confident and serious, because if you do not present anything, you're not going to learn. Remember, this is the age where data is everywhere. You can use chat GPT to actually teach you to learn, but you
Yeah.
then need to, you understand, you then have to be able to present
Understand.
before somebody what you've
Okay.
learned from your chat GPT, Google Gemini, whatever. But by the end of the day, you need to tell us, show us that you now know your thing. Is that correct?
Okay.
Good. There
All
is the
right.
first principle there, the going concern. This is the assumption that the business will continue to be there for the foreseeable future. The business is going to be there. So when we prepare our financial statements, we'll be telling the people that, hey, don't worry, next year we'll be there. Okay? If we are not going to be there, there is a way of preparing financial statements. We need to prepare them on a break-up basis to tell the people that please do not look forward for our existence, because next year we are closing shop. We won't be there. So when we are preparing financial statements, the assumption is that the business is going to be there for a foreseeable future. That is the period exceeding 1 year. Is that clear? Then
Yes, very
there is
clear.
what is called the accrual concept. The accrual
All
concept.
right. Uh,
This one, this one says income and expenses should be matched on a time basis, not just when cash is received. This is why we record an expense even if we haven't paid the supplier. For example, if we have utilized ZESA, all right, throughout the month, and we ended up paying 15 days after the month end. In that particular month, we should recognize an electricity expense, regardless of the fact that we are yet to pay ZESA or ZDEC. Is that clear? Similarly,
yes, very much.
Similarly, from the revenue side, if we have delivered the items to the customer has acknowledged receipt of the item on a sale contract, we have
Uh,
made sales regardless of the fact
uh,
that we haven't received anything.
all right.
That's the actual concept. So when we prepare those financial statements, remember these concepts, these accounting assumptions are there to guide us when we are preparing financial statements. Some people
All
or some
right.
managers or some supervisor will come to you and say, hey, don't record this cell because we haven't received anything. You need to tell them that we use the accrual concept. Unless you are not preparing your financial statements in terms of accounting standards. But if you are doing that in terms of accounting standards, we need to recognize a cell no matter
Okay.
the amount the money has been paid by the customer. The moment we have dispatched the goods and the customer has acknowledged responsibility over those items, then a
Uh,
sale has been done.
okay.
Good. Then there is an assumption or there is a theory of consistency. Financial statements, financial statements should be drawn up using the same approaches each year. If, for example, the way an amount is measured is altered, then profits could be affected or manipulated. Here we are saying if we are using depreciation method, say reducing balance method for a certain item or a group of similar items, then
Uh,
we should consistently do so,
all right.
because if we change each year, then our financial statements are not going to be very useful to users. Is that clear?
Yes.
Good. Number four, the double entry principle. This one says
Uh,
that every transaction has a matching debit and credit entry in the bookkeeping system. So when you do a transaction, it is going to trigger a debit and a credit and at the same time. Okay. So, all right. So when you are doing your books, just think, oh my God, in this Sage thing, all right, I've posted this one on the debit. So what was the credit impact? All right.
Uh,
Yeah. If you don't do that, your trial balance is not going to balance. All right. In business entity concept. This one says that accounting records record the transactions of the business entity, not the transactions of its owners. So similarly, this one is sometimes called the separate um, entity concept, separate entity concept. Okay, where we are saying that the owners and the business are two different things. All right.
okay.
So when you make a sale, even if you are the owner of the company, please just know that when you take that amount, that money directly from the company and you buy bread, you have actually made some drawings. All right. Why? Because even if it's your money, you need to do proper bookkeeping. This is
Yeah.
why a lot of business have got problems with Zimra. All right. They just say, oh, this is my business. I do whatever I want. No,
Yeah,
you don't do
potato.
whatever you want. Yeah, you don't do whatever you want. You need to observe, accounting rules and assumptions. Then number six, materiality. An item is material if its misstatement could alter the economic decisions of users of the financial statements. Immaterial items do not have to be disclosed. Indeed, too much information can be confusing. So we are simply saying we need to account for things which are material, but it doesn't mean that even a 5 cents has to be ignored. But we are simply saying if it happens that a 5 cents could not be accounted for, we shouldn't waste the company's resources in investigating it. All right, so we need to record those items which are of paramount import, which are significant. All right, remember, it's also an issue of company policy. What we consider material in one company could not be material in another. Okay.
Yeah.
All right. Number seven, historical costs. Transactions are recorded at their historical cost. All right. So when we are saying historical cost, we are simply saying the original cost of the item
Uh,
has to be recorded in the books, not the other way around.
yeah.
Okay.
Okay.
Anyway, anyway, there's one important point I want to say. If the conceptual framework conflicts, if the conceptual framework conflicts or ends up conflicting with an accounting
Uh,
standard, if it ends up conflicting with an accounting standard, please
uh,
go for the accounting standard and not the conceptual framework.
okay.
There are accounting standards that actually say that you need to record the item at fair value. For example, so if the accounting standard is saying that that particular transaction has to be recognized at fair value of the amount concerned, then you need not
Uh,
to use historical cost, but the fair value. So
okay.
even if there is an assumption, the historical cost assumption, you then have to be
Okay.
guided by the respective accounting standard. Is that clear?
Okay.
Good.
Yeah.
So I said there is what is called the conceptual framework 2018. It's actually a 2018 version. You need to download that, the recent version. Okay. And they are accounting standards, what are called IFRSs or IASs. All right. So those are the accounting standards. You also
Okay.
have to have the recent handbook All this can be downloaded online, free of charge. Just to appraise yourself of these, theories and
Standards.
standards.
Okay.
Right.
All right.
Okay.
Cool.
This is what is called qualitative characteristics of accounting information. Qualitative, not quantitative. Qualitative. So, accounting information has to be relevant. That's the first item there. The information has to be relevant, which means financial information is regarded as relevant if it is capable of informing decisions of users. So, of influencing the decisions of users. So, if you simply make a report and it is not bringing any impact or any value to the users of that report, then it means that you just
Yeah.
have to squash the paper and throw it in the dustbin. So your report should add value, should be meaningful. So how can it be meaningful? It has to be relevant to the situation. Let us say we are talking of the performance of a certain business unit, all right? And then you end up bringing information about another entity, not the entity in question. Then it means that
Yeah.
even if your report was correctly done and everything else, it is not going to be useful because it is not speaking to the things which are required or to the particular entity in question.
Yeah.
Okay, great. Let's talk of faithful representation. Financial information must be complete, neutral, and free from error. Otherwise, it will mislead users of the financial statements. So when auditors come, they normally look for this qualitative characteristic, faithful representation. They will be looking for completeness of the items. We can say something is complete if we can actually, verify that it was recorded in full and the recorded item is actually in existence. So sometimes we start from the item to the books, all right, or from the books to the item. So if we see
Okay.
that everything that was supposed to be recorded has been recorded, then we can satisfy
Yeah.
ourselves that the recording was complete. Okay. Then
Okay.
if the information is said to be neutral, we are simply saying that there were no biases. We do not want to
Right.
see the accountant's voice. We just want to see the information speaking on its own.
Yeah.
All right. Right. Then, free from error. We are not saying the information should be 100% correct, but we are simply saying that all the errors which were known or which can be reasonably known have been rectified, have been corrected, and are not available in the document. All right. So you need to be very, very cautious. You need to be very, very careful when you are preparing the financial statements. Put all your attention on them so that you produce something that could be judged very correct. We are not saying it should be absolutely without errors. Errors sometimes are inevitable, but please exercise all the caution. Exercise all the caution. And remember the aspect of faithful representation.
Uh,
Okay, we are done. So, as part of your assignment, This one, this particular assignment, I want you to tell me the items according to the conceptual framework which speaks of relevance. What are we talking about? There are certain notes I want you, just a one-page document you send me on WhatsApp, something more about relevance. All right? I want you to
Okay.
tell me something, all right, about relevance. We didn't talk much about relevance, but there are certain things there. All right. You need to tell me about relevance from the conceptual framework.
Okay.
So I want to see this by tomorrow morning at 9 o'clock a.m. All right. Now, so these ones were actually fundamental qualitative characteristics, those two, but they are enhancing characteristics. These ones, they are called enhancing from 3 to 6. They simply enhance those fundamental characteristics, those two. Okay?
All right.
So there is comparability. We are saying when you prepare your financial statements, these financial statements should be able to be compared. If other people from from other companies or from another industry want to evaluate themselves against you, they should be able to do so using your financial statements. So this is why we are saying you need to follow accounting standards so that the comparability of information becomes possible. If there are no standards, how can we compare A and B? It becomes difficult, isn't it? But if everyone is following accounting standards, then there is comparability. Then
Okay.
verifiability. This one says that the account information should be capable of being verified through auditing procedures. So every auditor, any auditor, whether from Ernst and Young, from Deloitte & Touche, or from these small audit firms, if they come to audit, to review your financial statement, they should be able to do so to verify if the figures actually are correct. Auditing procedures. If it is impossible to verify the documents the amounts you have stated in the financial statement, then the qualitative characteristics of accounting information do not exist in your report. Then we can safely say it is of poor quality. Why? Because they are failing to meet those thresholds. Your figures can't be verified. Then what did you report about? Where did you get them? You understand? Right. Timeliness. There is no use in preparing a good report, which is required in just 2 weeks' time, but it is prepared after 6 months. So if there is no regard to time or to timelines, then there is nothing we are doing there. We should go home and relax. So we need to give credence to the timelines. Lastly, understandability. Do not use crazy jargons in those reports to show them that we have passed certain stages of the ACCA, so you can now write those big words. No, it is not going to help us. Please present your information in as understandable a way as possible.
Okay.
Any questions on that part before we jump on?
No, it's clear.
So we can proceed.
Yeah.
Right. Accounting standards, we have spoken about why we need this one. Different accounting policies mean that it is hard to compare different entities. So accounting standards are there to bring some advantage when it comes to comparability of information. So we now know that if we are talking of sales, there is a way of presenting sales. If you are talking of liabilities, there's a way of presenting them. There's also a way of interpreting how we should treat a certain liability and so forth. So standards enable comparability of information. All right, to bring consistency and prudence to the preparation of financial statements, now potentially three sources of rules for many account issues exist. So sometimes you discover that there are also national laws to bring some, some sanity in the way these figures are going to be presented. Sometimes national laws are, are enacted to ensure that certain figures have to be treated in a certain way. There could be some local
Mm,
accounting standards. Local accounting standards, for example, in Zimbabwe, we have got the Zimbabwe Financial Reporting Manual. It tabulates and regulates certain reporting requirements, especially for the public sector, which should be observed, and they
mm,
do such things. Then there are IFRS, the International Accounting Standards or International Financial Reporting Standards. These ones are the ones which affect us, which are going to be tested in this examination going forward. And all the other examinations, you are going to face the IFRS, all right? Now, national laws take precedence, then local standards, then international standards. Although many countries are adopting international standards, Zimbabwe is adopting international standards. But if the PAAB has come up with accounting standards, we need to follow those ahead of the IFRS, isn't it? But at the
mm,
moment, we are using the IFRS and so forth. All right. These standards, the IS and IFRS, are developed by the International Accounting Standards Board in liaison with users of financial statements, academics, auditors, accounting bodies, and industry. So they do some consultation and so forth to ensure that those standards speak to the industry and are beneficial to the industry. They are real. They need to be real. Even if there is a certain dedicated body like this IASB, that ISB doesn't operate on its own. It do some consultations to ensure that whatever it is going to bring up is something that is real to the existing world. Is that
mm.
clear? Uh,
Yes.
let's move on. So there are certain accounting standards I want to. All right. So this first one, the IAS
Mm,
one presentation of financial statements, I want you again tomorrow to show me the recent naming or the recent standard that has been uh, issued that has replaced this first standard. It has been replaced, this one. It is now an IFRS name. It is now a new IFRS. So you need to show me, to tell me, hey, say, this is the new standard we are talking about. IAS 1,
okay.
IAS
Uh-huh.
1, presentation of financial statement is no longer there, isn't it?
Mm,
Okay, and then there is IS2 inventories, IS16, IFRS 15, IS37. Um, the inventory standard tells us about how we are going to value inventory and how to treat inventories at a certain stage. All right, that's the purpose of
mm,
IS2, right? Remember, inventory is valued at, just to remember, we value inventory at what? At the lower of,
and
at the lower
yeah.
of lower of cost and net realizable value. All right, good. That's how
Mm,
we value inventory. All right, don't worry about what does that mean, say, and so forth. We'll tackle these things as we proceed, isn't it?
mm,
IS16, property, plant, and equipment. All right,
mm,
property. This term property is, usually confuses people. I've attended a certain funeral where the auntie was complaining that, oh, these people where my brother had married from were so cruel. They took everything from my brother's house. Every property was on it. But when I asked this auntie what property was taken, she was telling me of the bed, the computers, the Mombes, goats, pigs, all those things. Please,
Uh,
for this standard, property,
uh,
property, property means buildings and land.
okay.
That's property. Those other
All right.
things are not property. Okay, great. Now you understand. You have learned something, I hope. Then plant and equipment. So the rest of the items could be, equipment, plant, and so forth. All right. So that's the issue there. Now, this standard is actually one of the biggest standards and troublesome standards. The aspects of depreciation are in this standard. The aspects of um, certain recognition criteria for proper plant equipment, they
Okay.
also come and confuse people. Aspects of revaluation, all those things, they are in this standard. So please pay very careful attention. Then if it's 15, revenue, how we, recognize revenue, how we
Mm,
treat sales, those items. Then International Accounting Standard 37, provisions, contingent liabilities, and contingent assets. These, I've simply just put these few for your appreciation of what accounting standards are. And I'm sure you've also observed that there is what is called IFRS and also um, IASs, right? Both of these are accounting standards. Initially, they were international accounting standards. However,
mm,
around 2000, somewhere there in the early 2000s, that's when we started to have IFRS. So we have shifted from IASs to IFRS. But now it doesn't mean that IASs or IASs can now be expensed with. No, we still have some which are still valid. All right, so you understand, for example, this IS2 is still valid. We need to use it. IS 16 is still valid. So even if we are now talking of accounting standards as international financial reporting standards, they are still international accounting standards, bearing the
mm.
original term, the original name. Anyway, as
Only one we're not using is number one, IS1.
yeah, that IS1 there. Yeah, I want you to tell me the standard number, the new standard number, and show me that standard. You have to look for it online and give it to me. That's your assignment. Only that. Is that too much to do?
No.
Right. So I've spoken about these standards, and you can see the notes have got those standards. But this one, the first one, I told you, this first one, please tell me if you could do this short summary of the recent standards. When you're telling me, just write a short summary the way I did here, and send me on the
Mm,
WhatsApp platform to tell me, hey, say I found the standard, this is the standard, please, it is saying A, B, C, D, and we can move forward. Those
okay.
are the summaries for the IS16 I told you about. If it's 15, IS 37, those summaries are so important. Okay, I don't know what's happening with these annotations. Anyway, I'm sure you can see the document clearly, or
Mm.
maybe you can see things clearly, right? Good.
Yeah, I
There's one
can.
tool, or you want me to tidy the screen?
It's all
I'm
your
afraid.
squiggles only. Why some
Okay.
are squiggles? Akawanda, wangochiti.
I don't know
You were teaching others.
yeah, hey. And the eraser is actually saying, oh man, you can't erase me.
Mm. It's okay. You can carry on.
I forgot to clean up when I was doing the lecture with other people, so I'm sorry. Okay, I'm sorry for that. Now, there is what is called accounting equation. And this is a recap,
Uh,
remember. This is a recap.
mm,
Assets is equal to capital plus liabilities. All right. Since the business is a
yeah.
separate entity, since a business is a separate entity from its owner, it therefore follows that the business can owe money to or be owned money by its owners. All right. So when you put capital in your business, in your side hustle, the business is owning you money. But that, I mean, that owning the business is have
Uh,
has got a special term called capital. All right, that relationship between you, the owner, and the business, that transaction becomes what is called capital. If you inject your money,
mm,
it's a loan to the business, remember, because you guys are separate,
mm,
you are different people. So it is actually a loan, but it is a special loan from the owner of the business. So we give it a name, capital. It is different from other loans, which are given by third parties, the banks. Is that clear? This is why you
mm.
find these guys, this why you find them on the credit side. They all bear the credit side. Why? Because they are loans. At some
Okay.
time in the future, they have to be repaid. When the owner doesn't want
Mm,
to do any trade anymore, he just says, please, I want my money. I want to go to the village. I'm done with the shika shika. Okay, that's great. Okay, so that's the accounting equation. The assets is equal to capital plus liabilities. So in the examination, sometimes they give you they rearrange these formulas and so forth. So you just have to know the principles of your body mass, your subtraction, how we treat liabilities when we move something. Here the capital, as you can see, the word capital has no operation there. It means it's a positive. But when you start to say, when you shift this capital to to this left side, it becomes
mm.
negative, right? So sometimes you see an equation like assets minus capital is equal to liabilities, or B assets minus capital is equal to minus liabilities, then you have failed. Okay, so you need to know
Mm,
when you are shifting these guys to the other side of the equation, they tend to change the operation before them. It becomes negative. Is that
mm.
clear?
Yeah.
Great. So just memorize this as the fundamental setup, the original setup of the equation. Assets is equal to capital plus liabilities. This is actually the balance sheet, because when we make our balance sheets, when our balance sheet, the assets should equal the total of capital and liabilities. So it is actually
Abilities.
the balance
Mm,
sheet. Okay.
okay.
So hey, this one is too much. Just give me 1 minute so that I tied up these things. Amen. They are annoying me. They are annoying me. But seems like, hey, they are now permanent. They are saying you can delete us. Oh my God. They can't go, Lucretia.
You can't go. Uh-huh.
Um, oh, I found it.
There you go. There you go.
Seems like I've been lucky. It's better now. Okay. It's technology, so sometimes it vexes us.
Mm.
Okay. Now, the accounting equation modification. So, remember we started with this original equation: assets is what capital plus liabilities. But sometimes the
Mm.
equation can become complicated, but it's not that complicated, but it can happen. So, assets is equal to capital introduced plus retained profits plus liabilities.
Mm.
So what it means is um, the assets we have in the business, they should equal to the capital, the amount of capital we injected, plus any trading profits we made or we kept in the business. Those are the retained earnings, plus the liabilities. Okay.
Okay.
Then we have this animal called net assets. Net assets are or is the difference between total assets less
Mm.
total liabilities.
Okay.
All right. So we can arrange the accounting equation to help us to calculate the total capital balance, which we have seen in the sum of capital introduced plus retained profit. So we are simply saying assets minus liabilities is equal to capital. But remember, when we say assets minus liabilities, we are referring to net assets because we said net assets is equal to total assets minus total liabilities. All
Mm.
right. But remember, in the accounting equation, if we rearrange this equation, if we remove the capital from the right side to the left side, if we remove the liabilities from the right side to the left side and say assets minus liabilities, we are going to be left with capital on this side. But that relationship or that difference, the assets minus liabilities, is technically called net assets. Why are we saying net assets? The word net, when we did our taxation or the net tax and so forth, we are simply saying there was a pool of assets in the business. There is a pool of assets. All right. So
Mm.
if
Mm.
we deduct all the liabilities of the business, we'll be left with the net assets. Those net assets are the rightful things which are owned by the owner. He doesn't own liabilities. So we first remove the liabilities. If we look at the assets of the company, all right? If we're looking at those assets and say to ourselves, so how much from these is the owner entitled to? All right.
Mm.
So we can only
Mm.
determine the amount the owner is entitled to after we pay the creditors, isn't it? We will be left
Uh,
with
uh.
what is called the net asset, and that is the
Need
capital of the
assets.
business.
Okay.
Okay. So
All right.
don't be vexed by the term net asset. All right. It only refers to the difference between assets and liabilities. Okay. And it is also
Okay.
the other term for capital.
Okay.
All right.
All right.
Good. So net asset is what capital. So sometimes the examiner gives you the figure of net assets. Please know that that figure of net assets is the capital figure, is the figure for capital and so forth. All right.
All
So
right.
there's an example there, but the computer is almost about to shut down. I want us to do some example. All right. You read this part. I'm going to send you the notes and so forth. You read the part where you find it challenging. Please, Lucretia, don't run away from your tutor. Just ask me. where you are stuck, please ask me anytime, any day. I don't want
Okay.
to behave the same way I used to do, because I discovered that, oh man, my students are running away because maybe I was too harsh with them. So ask me anything, anytime, any day. Okay, when you're stuck, please ask me. Don't run away from the tutor. Is that clear? Okay.
Yes.
So those are the items. There is this particular point I wanted us to, the modification of the accounting equation sometimes becomes so complex and so forth, but please do not be vexed. Okay.
Uh,
So now, in this accounting equation, we have been also taught that asset is called capital introduced. Okay, that is the capital the owner is introduced the business, plus any profit that was earned minus that amount the owner took from the business. So that's why I said, when you took money from your business, you have made drawings, you have withdrawn money from the business. So we need to deduct it. Then we add the liabilities. So the reason why we are adding liability is just the way it was from the beginning, because liabilities were also added here from this original equation. There was a plus liabilities, isn't it? So nothing has changed. So don't say, hey man, things are now complicated. They are not complicated. And this is also explained here why we have all these things. So when you're stuck, please ask me. Now, the business equation. So sometimes the examiner would want you to tell him about the profit the business has earned. So if we come back here again, uh, any of these items, any of these variables, sometimes the equation can start with liabilities. So just know how to rearrange, just know how the original equation is mapped. This is the mapping of the original equation. Okay, so the examiner will do some tricks to add other variables, the profit that has been earned, less the drawings and so forth. This is also the original setup where we have got some profit that has been accrued over the year, and then some drawings which were deducted, all those things. All right, so we have now come here. Now the profit has been put on the first part here of the equation. So if we have the profit here, the profit is equal to increase or decrease in net assets in the current period. Increase or decrease in net assets, we are simply saying we are starting from the original net asset or the original capital, all right? The original difference, all right? Remember, net assets, I told you, net assets is assets minus liabilities, right?
liability.
All right? That's net asset, isn't it?
Yeah.
So you might be given this net asset figure at the start of the year and net asset figure at the end of the year. All right. So you need to separate those two figures to get the increase or decrease. How can you say there was an increase or there was a decrease? There was an increase if the original net asset figure is less than the closing net asset figure. Then there was an increase. But if the original net asset figure was so high than the closing, then there was a decrease. Is that clear? Greg, don't want there is an example. I hope so. We are going to do together. And then we need to add drawings in current period. Remember, here we are adding drawings, but originally, if we start with the assets here, the drawings were deducted. But here we are not starting with the asset, we are starting with the profit. Is that clear?
Yes.
Great. And then we deduct the capital introduced in current period. All right. Sometimes the examiner will tell you that the owner re-injected another capital. Remember, I said this one, the net asset is the capital. Remember, right? So these are the figures of the original capital we were talking about. But remember also that that capital is the difference between assets and liabilities. I'm sure you now remember. Please replay this part of the video If you are vexed. All right. So it's just an issue of playing with technologies. All right. So
Oh,
the word capital is also found in this relation, in this aspect, the net assets, because we are saying capital in the original equation, right? The original equation here, this capital can be a loan figure on the right side of this equation if we have, migrated or exported the liabilities to this side. If they move to this side, they become assets minus liabilities is equal to capital.
yeah.
And we said, and we have agreed that when we say assets minus liabilities, we are referring to the term net assets. Is that clear? So net assets is
Yes.
actually another term for capital.
Capital.
All right, please get that straight. Okay, let us do this example together to cement our understanding. The net assets of Broader's business were 15,000 at 1 April 20x3 and 25,000 at 31 March 20x4. All right, during the year, Broader paid lottery winnings of 2,500 into the business. So you can see that this was capital which was introduced in the current period. Remember, on our formula, all right, into the business, and he withdrew 1,000. So that one is a D. All right, from our formula. If you get into the exam hall and you are told that you need to calculate the net profit for the year ended 31 March, obviously you need to enter into that exam with, a certain figure, a certain formula where we saw that P, there was P is equal to increase or decrease in net assets, remember? Okay, plus D, isn't it? There was plus D. I'll cross check that one. Minus the capital which was introduced. So obviously to do this one could be very, very simple. All right, so all we need is to understand what was the increase. And I said the increase could only happen if the original net asset figure was less or was lower than the closing. Then there was an increase. All right. It simply means that we started low and we've increased when we were closing, isn't it? But if
Yeah.
there is a decrease, it means that we started high and ended up low. So simple, isn't it? Great. So now, which one is our I? The I here is the difference between the closing 25,000, which is higher than the 15,000. So there was an increase. So an increase of how much? 10K. I do not have my pad here because if I use pad, then it simply means that the computer is going to close, it's going to shut. Then the drawing was 1K. All right, he withdrew 1K there. Are we together? Are we seeing where I took the 1K from? This is the 1K
Yeah.
we're talking
Yeah.
about.
Yeah.
Through 1,000, all right? And then he introduced a certain capital there during the year, which was how much? He introduced 2,500 from his lottery winnings, okay? 2.5. So tell me the answer. What is the answer there? If you use your calculator there, that side.
11 minus
That's 2.5.
2.5.
Obviously, that's
8.5.
8.5, right? So this is our answer. Very simple, isn't it?
What does the P stand for?
The profit. This is the
Profit.
profit end in the current period. Is that too much to bear?
All right. I get it.
So we are
So there's
together.
an accounting equation and there's a business equation. It's like a
Yes.
two.
Oh, yes.
In the
Yeah.
two. Why can't they just be one?
All right. It's a good and great question. All right. It is still the original accounting question, but we have simply rearranged the question. We have simply rearranged it in the sense that we are now inclined on profit. All right.
Oh,
But
okay.
you can safely say that this is now a more advanced accounting equation, but it's still the same idea because initially we were talking
So
of
if
the
that
net
one relies on profit, what does the accounting equation rely on?
profit. The accounting equation was, remember, also has got this profit. If you can rearrange this, you will safely come to that P.
Okay.
Still the same equation. And
All right.
I want you tomorrow then to actually tell me.
Mm.
The only thing here is that here, this setup, we haven't traded, or let me just say, we haven't introduced any other capital. All right. There is no capital which has been introduced in this one. That is the variable that is missing. All right. And we
Okay.
have also not considered the you know that or we haven't done the net assets aspect where net assets, remember, is assets minus liabilities. All right, we haven't done that, but all the same, it's actually the same accounting equation. Because if you rearrange, for example, this P, remember, if we remove
All
this
right.
P to that side, it
Yeah.
becomes negative. But if we let it on its own, or if the P remains on this side, it simply means that we are going to have the assets, all right, the assets minus this guy is going to come to this side, right? If it comes to this,
Uh,
if the liabilities come there, it means that they become negative L, okay? Minus liabilities. And then let us import drawings. If we remove the drawings to the other side, remember, we want to make P the profit subject of the formula. So we want to leave the P alone on this side. So it means that the drawings will come this side as a positive. And remember, in our P, the drawings were positive in our P formula, right?
yeah.
Okay. And then which L, what do you say? Or the capital here, if we move the capital to that side, it becomes what? Negative, isn't it? So the capital will be minus C is equal to P. Okay. And our I, remember our I is this figure, assets minus liabilities. Assets minus liabilities in that equation, assets minus liabilities is equal to what? Net assets, isn't it?
Capital.
Uh, Assets minus liabilities, yes, it's capital, but the term which was used in this
Net
formula, the P,
net
is net
assets.
assets, right?
Okay.
You understand? So we are having the net assets, but the only thing now is that we compared the net assets at the start and at the end, and we came up with an I, the increase. So this is why instead of putting A minus L, we put I. So we said I plus D, okay? Plus D, sorry, plus D minus C, which was equal to P. So you can see that it was just a rearranging of the same thing. Or you are lost somewhere.
Afunga msoro wa neta manje.
Sorry, Sha. Okay, not better wrong. So I want you to do this last question, and then I think my computer is about to rest now. Can you attempt this? I give you 1 minute using the things we've done. I give you 1 minute to 2 minutes, 1 to 2 minutes.
Okay. James business in December 2009 of 47,154,000. During the year, the business borrowed 2,000 from the bank and the corporation introduced additional capital of 22,000. So drawings of what profit or loss was made and net assets. 7,000.
Okay, now let us do together. Because the computer is about to go out.
Mm.
Okay,
Okay.
it's about to shut. Did you get the answer? Okay. All right. So let us do together. So we know that P, because the question wants us to determine the profit or loss made by the business. So we know P is equal to what? P is equal to increase or decrease, right? In net assets, plus what? Plus drawings, minus what? Minus capital introduced. All right. So what is the increase and decrease here? At the start of the year, we had 47,100, and at the end, we had 54,200. So there was an increase because the later figure was so high. So there was an increase in net assets, remember. Okay? Because the examiner is saying that the business had net assets. Is that clear, Lucretia? Hello? Hello? You have been booted out.
Yeah, hello.
I'm sorry, maybe it's an issue of network, and we are actually
Okay.
hanging on the edge of shutting down.
Uh,
Yeah, the battery is almost flat now. Okay, I do not know if we're gonna finish, but all right. So the I is the difference between 47,100 and 54,200, and that difference is how much? Did you get that difference?
7.1.
7.1, right? So that's our 7.1 point one plus the drawings was how much?
2,000.
Is it made drawings of $200 per week? How many weeks are we talking about?
$100. Uh,
It's it's $200 per week. So if it is $200 per week, so it simply means that that's 200 multiplied by how many weeks in a year?
52.
So
52
2
weeks.
plus 52, right? I mean multiplied by 52, right?
Mm.
Okay. If this computer, went down, please, I want you to give me the answer tomorrow morning. Let's hope it won't, shut down. The difference here, minus the capital introduced was how much? How much?
Capital
22,000, right? 22,000. Okay. So, I mean, so 200 multiplied by 52 is how much? Please hurry. Oh my God. How much do you get? 52 multiplied by 200.
10,400.
So that's plus 10,400 here. Okay. Sorry, my power is now weak. Okay. 10,400. All right. Minus 22. How much do you get? 7.1 plus 10.4 minus 22. It's how much?
7.1 plus
0.4
10,400 minus
22,000.
22,000. Yeah. 4.5 minus 4.5.
It's minus 4.5. So is it a profit or a loss?
Loss.
Yes, it's a loss. So there was a loss of 4,500. She would to tell me the reason why we did not put this figure, the 2,000 here, which was borrowed from the bank. Because during the year, the business borrowed 2,000 from the bank, and the proprietor introduced additional capital of 20,000. So why are we ignoring the 2,000 now in our calculation?
I have no idea.
All right. Borrowings. These borrowings from third party.
Are these not the same as drawings? Borrowings. All
right. Drawings. We are not talking of drawings from the bank, but drawings from the business. If the owner takes out money, they are called drawings. But from the bank, they are called withdrawals. Okay? Good.
All right.
Now, if you withdraw money.
So shango financing a loan a borrowing, loan.
Yeah. So my borrowings are affected profit.
Okay.
All right. They have no bearing on the profit. So that is why we ignored them in the computation, and they are not there on that formula. Is that clear?
Yes.
Please. I thank you so much for joining Transcal Business School again. All right.
Thank you, sir. Mr. Jerry, thank you.
Thank you so much. Thank you. Enjoy your weekend, and I hope that you're going to do the assignment within the 7 days, and we will assume another lecture next Friday. Is that okay?
Okay. All right.
Good night. Goodbye.
Bye-bye.
Sure.